OptionChampion.com.
Today is Saturday, September 17th. I'm Rick Adams, and this is Tricks of the Trade.
All data and other information contained throughout this video are for demonstration purposes only and shall not be construed as trading or investment advice or an advertisement for software or other trading applications, nor shall any part of this presentation be considered a recommendation of securities or other tradable products or related strategies. Trading and investing, whether short or long-term, involve risks that may not be suitable for everyone. Any mention of past performance is not an indication nor a guarantee of future results, as volatile market conditions can arise at any time and result in substantial losses. No individual should make any trading or investment decisions without consulting a professional and conducting his or her own research.
Welcome to Tricks of the Trade on this day after Triple Witching Friday. Equity options, and index futures have fallen off the board for the month of September. October monthly stock options and December stock index futures are now in the front month cycle. In economic news, the consumer price index rose 0.1% month over month in August, compared to an unchanged reading in July, and missing the expected decline of 0.1%. On an annual basis, CPI fell to 8.3% from the previous reading of 8.5%. Core inflation, which excludes food and energy, rose 0.6% to 6.3% year over year. Producer prices fell by 0.1% month over month in August, in line with expectations, and increased 8.7% from a year ago. Core producer prices, excluding food, energy, and trade services, increased 5.6% year over year. Retail sales ticked higher by 0.3% in August, compared to the revised decline of 0.4% in the prior month, and beating the expected decline of 0.1%. Core retail sales, which excludes automobiles, fell by 0.3%, compared to the revised flat reading in July. And for the last bit of economic news, weekly unemployment claims came in at 213,000, down 5,000 from the revised 218,000 in the previous week, and below the forecast of 225,000. Tuesday's worse than expected CPI data sparked a massive sell-off in the equity markets. The Dow fell 1,276 points, the worst single-day decline since June of 2020. The S&P 500 lost 177, and the Nasdaq Composite plunged 633 points following the release of the August CPI data. The sell-off pushed the major market averages deep into negative territory for the week, with the Dow losing 1,329 points. The S&P 500 lost 195, the Nasdaq Composite lost 667, the Russell lost 85, and volatility gained $3.51. Crude oil fell 59 cents on the week, gold lost $43.10, silver gained 83 cents, and natural gas ended the week lower by 22 cents. Today we're going to look at hedging a long stock position, and in the case of my portfolio, the stock is Suncor Energy, symbol SU on the New York Stock Exchange. I bought the stock for $32.34 per share and will earn a profit only if the stock rises above that price. If the stock falls below that price, I will incur a loss. So I would make money from only one direction if the stock goes up in price. How can I protect my position from a substantial loss and at the same time potentially earn a profit from a decline in the stock price? The most common and most basic way for an investor to protect a long stock position is to buy a put option on the stock, a strategy known as a protective put strategy. A put option limits losses on the underlying stock and increases in value as the stock price declines. With my long stock position in Suncor, I could purchase a put option with a strike price of $32 per share and pay a premium of $1.51, or $151 per option, as options represent 100 shares of stock. If the stock were to have a significant drop in price, say to $25 per share, and I own 100 shares at $32.34 per share, I would have a loss of $734. But if I also have a put option with a strike price of $32, I would have the right to sell my 100 shares at $32, even though the stock is priced at $25 in the open market. By exercising the put option at $32, I would lose $34 on the stock, as well as the $151 premium paid for the option, for a total loss of $185 instead of $734. When I employ a protective put strategy, I like to throw on a little something extra. I like to reduce the premium paid for the put by also selling a put underneath it at a lower strike. You might recall from the previous episodes that this is called a long put vertical spread, where an investor buys a put option at one strike and then sells another put at a lower strike. So breaking down my Suncor position, I bought the stock for $32.34 per share, and as a hedge added a long put vertical spread with 39 days to expiration, where I bought a 32 put for $1.51 and sold a 31 put at $1.09. The $1.09 received from selling the 31 put offsets the $1.51 paid to buy the 32 put, resulting in a net debit of 42 cents for the spread. On a long put vertical spread, the maximum loss is limited to the debit paid, and the maximum profit is the distance between the strikes minus the debit paid. In this Suncor position, the distance between the strikes is $1. So the $1 wide spread minus the 42-cent debit gives this position a max potential profit of 58 cents per share. And the maximum potential loss is simply the 42-cent debit paid for the spread. If the stock price falls below the 31 strike of the vertical spread, I could close the spread for a profit, or if I wish to keep it on, I could roll it out to a later expiration cycle and change the strikes. If I choose to close the spread for a profit, I could modify the position by buying more shares to achieve an average price near the market price and then add short calls and a long put. If the stock price rises and I earn a healthy profit, I could close the stock position and lose the debit paid for the long put vertical spread. So far, though, the stock has fallen to $30.74 per share, and I've closed the long 32 put leg of the vertical spread for a profit of $104, leaving the short 31 put open as it still has 35 days until expiration. I'm considering buying more shares of the stock and then selling calls and buying another put, or I might just keep what I have left and let them run. It all depends on what the markets bring next week. That's it for this episode of Tricks of the Trade. I'm Rick Adams. Thank you very much for watching. See you next time.